This is our second lecture on project decision rules, and it will deal with IRR, or the internal rate of return. Our goals here are to describe the internal rate of return and how we calculate it. We'll look at a sample problem, and at the end we want to compare it with NPV to determine how it impacts project selection rules. First thing we need to know about internal rate of return is it is an interest rate, where NPV measures dollar return for a project. The IRR measures the percentage return for a project. You can almost think of it as a profit rate. So for every dollar we invest in the project, what rate of return do we get on that dollar? Mechanically, it sets the NPV equal to 0. So it's the interest rate that when we discount the benefits or future cash flows of a project back to today, it's the rate that lets that present value add up to the cost of the project. And of course, it's a profit rate, so the higher the IRR, the more successful the project. So here's the by hand way we'd calculate the internal rate of return. We would line up our NPV calculation, but instead of putting in the cost of capital, we put in the IRR rate. So it's the interest rate that sets NPV equal to 0. Another way to think about this is it's a financing rate. It's the highest cost of financing I can accept and still pursue a project. So it's some hurdle or a maximum interest rate is a final way to think about it. Our decision rule is simple. If our internal rate of return or profit rate is greater than the cost of capital, that's our financing rate, then we accept the project. So this slide summarizes sort of what I've said here. Hit pause and may review these bullet points before we move on to an example. Alright, a project requires a $100,000 investment today. Investors would like a 10% return on their investment. That's the cost of capital for the project. We have 3 years of cash flows. $50,000 in year 1, $50,000 in year 2, $40,000 in year 3, should the project be pursued. Our by hand equation sets NPV equal to 0. Now we need to solve for the interest rate. Now on a financial calculator, the only way to really do this is with the cash flow function. So we enter the cash flows. Make sure you have a cash flow at time 0. That's our initial investment, and it needs to have a negative on it because it's an outflow. Once we have the cash flows entered, we hit the IRR key and compute the IRR. So here, our internal rate of return is 19.69%. So for every dollar we have invested in this project, it returns 19.69% per year. So now our decision rule is this. The project has a profit rate of 19.69%. Our cost of capital or financing rate is 10%. So we would accept this project since the IRR of 19.69% is greater than the cost of financing of 10%, which is the cost of capital. Just relating the IRR back to the NPV, if we were to calculate the NPV at 10% and discount the cash flows, we get a positive NPV of $16,829. This means that the project generates extra value for our shareholders. So in other words, it generates beyond a 10% return, which is consistent with the IRR rule. Keep in mind, the IRR is the highest or the largest financing cost we could accept and still do the project.